Welcome to this explainer. Today, if you want to buy a stock, you just pull out your phone, tap an app a few times, and boom, you instantly own a piece of a publicly traded company. It's completely, wonderfully frictionless. But Wall Street wasn't always this digital marvel. Actually, to get to the lightning-fast trading we take for granted today, the financial system first had to completely choke on its own success, suffering through one of the most bizarre and honestly forgotten crises in modern history. So what happens when an unstoppable economic boom meets an absolutely immovable, archaic paper system? Well, the answer to that question directly ties your modern ability to trade securely from your couch to a massive existential crisis that literally pushed the epicenter of global capitalism to the brink of total collapse. Section 1. Drowning in paper. To really understand how we got here, we have to travel back to the booming post-war economy of the late 1960s, where beneath the surface of a roaring bull market fueled by prosperity and mutual funds, a massive disaster was brewing. Okay, let's dive into this. Throughout the 1960s, the value of traded stocks experienced this explosive, unprecedented growth. Wall Street had actually commissioned a study back in 1965 to project their future volume, and they predicted, they might hit 10 million shares traded per day by 1975. Well, they were completely wrong. They hit that 10 million mark just 2 years later in 1967, and it caught the entire financial industry totally off guard. The sheer physical volume of shares simply broke their traditional systems. I mean, the number of shares traded doubled between 1965 and 1968. The absolute peak of this frenzy hit in late March 1968. A speech by President Lyndon Johnson regarding the Vietnam War sparked this massive market rally, and the very next day, a record-breaking 17 million shares changed hands on the New York Stock Exchange. 17 million! Now, why on earth was 17 million shares such a huge problem? Well, it's because of how absurdly complex the manual process was back then. Every single trade revolved around a physical piece of paper, the stock certificate. A single purchase might require up to 68 distinct manual steps. 68. You had to transmit a signed and notarized certificate, send it to a bank transfer agent, usually by mail or literally a messenger running down the street, wait for clerks to manually update corporate records, and finally issue a new physical certificate. The system was literally choking to death on a blizzard of paper. This brings us to a really critical term from that era: fails. A fail occurred when a broker simply could not deliver the physical stock certificates to the buyer within the mandatory 5-day settlement period. It essentially became the core metric of Wall Street's impending doom. Because at the end of the day, an undelivered security is a massive liability. And how bad did those liabilities actually get? $4.12 billion. That was the staggering value of undelivered stocks, those fails, at the absolute peak of the crisis in December 1968. To put that massive number into perspective for you, the entire capitalized wealth of all the public-facing firms on the New York Stock Exchange at the time was only about $4 billion. Let that sink in. They owed more in unresolved, messy paperwork than their entire industry was actually worth. To handle this, Wall Street went on an absolute hiring frenzy, throwing thousands of untrained clerks at the problem. But the back offices became what one government report called a trackless forest. You had clerks working grueling 12-hour shifts 6 or 7 days a week. Just listen to this quote from a clerk at the time. "I worked in the dress factory snipping loose threads. Down here, I just check numbers. I don't know what it's all about, but it never ends." Turnover hit 50%. Morale was absolutely destroyed. Section 2. The Wednesday's shutdowns. Facing a literal existential threat, the industry had to resort to some truly bizarre and desperate stopgap measures just to survive. The epicenter of global capitalism had to take a step so extreme it's almost funny in hindsight. They literally closed their doors for a full day every single week. For the latter half of 1968, they shut down all equity markets on Wednesdays. No trading at all. And they even shortened trading hours on the other days, closing up shop at 2 p.m. Why? Literally just so the exhausted clerks in the back office could try to do their filing and catch up on the mountains of paperwork. Desperate for a quick fix, firms started throwing millions of dollars at giant early mainframe computers. But here's the thing. You can't just plug a computer into a chaotic, fundamentally broken system. Firms fed incredibly erroneous, messy, manual records into completely untested software. The result? Classic garbage in, garbage out. The venerable firm McDonald & Company bought a $3 million system that completely failed, leaving them with what one executive perfectly described as the front end of a Rolls-Royce and the back end of a Model T. And look, these weren't just harmless administrative hiccups. This was a massive financial disaster. The botched computerization and the endless paper crisis led to Lehman Brothers temporarily misplacing $473 million in securities they literally couldn't find the owners for. That McDonald & Company system failure we just mentioned, it caused 4,500 massive account errors. By the end of 1970, the sheer cost of trying to sort out this absolute nightmare forced nearly 1/6 of all U.S. brokerage firms out of business entirely. Section 3. A 183-year-old cartel. So let's slow down for a second and ask a really important question. How did the wealthiest, most powerful financial hub in the world find itself operating with the infrastructure of a 19th century counting house? The disease behind those symptoms was fixed brokerage commissions. Dating all the way back to the Buttonwood Agreement of 1792, the New York Stock Exchange operated as a highly protected, exclusive club. Every single member firm was mandated by exchange rules to charge the exact same, uniform, non-negotiable minimum fee for trading, usually around 1 to 2% of the trade's value. So the crucial takeaway here is this. Because they couldn't compete on price, brokerage firms felt absolutely zero financial pressure to make their operations more efficient or to modernize their back-office infrastructure. They were guaranteed high profits regardless of how painfully inefficient they were. This oligopoly basically locked out everyday retail investors with heavily inflated fees, but as the paperwork crisis fully exposed the rotting floorboards of Wall Street, the government finally took notice. By 1972, the Department of Justice actually filed an antitrust suit against the New York Stock Exchange, declaring this fixed pricing system an illegal, cartel-like barrier to free market competition. Section 4. May Day Deregulation. The breaking point had finally been reached, and the SEC decided it was time to step in and force a total structural shift on Wall Street. Let's move to and see how this builds. This breaking point was literally centuries in the making. You have nearly 2 centuries of a fixed-rate monopoly starting in 1792. Then, the 1968 paperwork crisis proves the system is dangerously broken. So in 1973, the SEC puts its foot down and announces that fixed commissions will be entirely eliminated. The deadline was set for May 1, 1975, a date the industry ominously dubbed May Day. Now, the pushback from the Wall Street establishment was incredibly fierce. They fought it all the way to the Supreme Court. They claimed deregulation would cause total market chaos and literally destroy the industry. The chairman of Morgan Stanley publicly went on record predicting that 150 to 200 firms could fail shortly after May Day due to collapsing profit margins. They were absolutely terrified of having to actually compete. And this brilliantly illustrates what they were really terrified of, the complete flipping of their entire business model. Pre-1975, you had to pay inflated fees that forcefully bundled the cost of trade execution with the brokers' research reports, their advisory services, and even their fancy client lunches and sports tickets, whether you wanted any of that or not. Post-1975, brokers had to unbundle these services. Firms now had to compete purely on the price of trade execution itself, which finally gave retail investors direct, affordable access to the markets. Section 5. The modern market emerges. Spoiler alert. Wall Street didn't collapse on May Day 1975. Instead, from the ashes of that bloated, paper-choked cartel, a highly dynamic, modern market began to emerge almost immediately. The breakthrough was phenomenal. Standard commission rates were instantly slashed by up to 50% as firms fought tooth and nail to keep their clients. A brand new breed of business, the discount broker, was born. A relatively new firm named Charles Schwab launched its first retail branch in September of 1975, marketing low-cost, stripped-down stock trades to regular, everyday individuals. Simultaneously, organizations like the Central Certificate Service finally started succeeding at digitizing paper transfers, turning stock ownership into computer entries rather than physical paper. This unbundled, digitized environment directly laid the technological groundwork for the frictionless online trading platforms we rely on today. The long-term benefit to the everyday investor's wallet has been absolutely incredible. Between the early 1970s and the late 2000s, standard brokerage commission fees plummeted by about 95%. We went from an average of 80 cents a share down to just 4 cents a share, which eventually paved the way for the zero-commission trading models that are so completely prevalent right now. So, as we wrap up this explainer, I really want to leave you with a thought. The frictionless apps sitting on your phone right now, they only exist because an old system failed so spectacularly that regulators had to step in and literally break up a 183-year-old pricing cartel. It kind of makes you wonder, if forced deregulation could turn an exclusive, paper-choked monopoly into today's hyper-efficient digital market, what archaic, insanely inefficient system out there right now is ripe for disruption next? Thank you so much for joining me, and keep learning.